Most people spend their entire lives saving money, and in the end, they have nothing to show for it. Not because they didn't work hard, but because no one ever taught them the one move that actually builds wealth. Here's the truth. Saving money is not the same as growing money. A savings account feels safe, it feels responsible, and for most people, it feels like enough. But while you're sitting there watching your balance barely move, inflation is quietly eating away at your purchasing power, year after year. So if you've been saving and wondering why it still feels like your money is never enough, that's exactly why. And today, I'm going to show you the step-by-step path to turn that dead money into a machine that works and grows while you sleep. We're going to start from zero, from I have some money in the bank and no idea what to do with it, all the way to building a real investment strategy that actually makes sense for your life, without needing a finance degree, without weird technical terms, without complicated charts, just a clear, honest path that anyone can follow. And I'm also going to show you the mistake that destroys most people's investment plans before they even get started. So stay with me, because this part is critical. Let me start by painting a picture for you. Imagine two people, both are 25 years old, both have $10,000 saved. The first person, let's call him Marco, puts that money into a savings account. He leaves it there, feeling good, feeling responsible. 20 years later, Marco checks his account. With a typical savings account interest rate of around 1% per year, he has about $11,200 in 20 years, barely a little over $1,000 in profit over 2 decades. And meanwhile, inflation can quietly eat away at purchasing power year after year. So that same money actually buys less now than it did when he first saved it. Marco technically has more dollars, but in reality, he is poorer than before. Now meet Sophia. Same age, same $10,000, but Sophia does something different. She invests that money in a low-cost index fund that tracks the stock market. Historically, the stock market has generated an average return of about 10% per year over the long term. 20 years later, Sophia's $10,000 have grown to more than $67,000. Same starting point, same amount of time, completely different result. The only difference: what they did with the money. That is the gap between saving and investing. And once you see it, you can't unsee it. But this is where most people get stuck. They know they should invest. They've heard it 1,000 times, but they freeze. Because investing feels overwhelming. It feels like something for rich people, or for people who understand numbers, or for people who have more time to figure it all out. So they keep leaving their money in a savings account, telling themselves they'll figure it out later. But later never comes. And every year they wait, they lose. So let's break this down into a clear path. Step by step. No excuses, no confusion. Step 1. Build your foundation before investing a single dollar. This is the part no one wants to hear, but it's the part that saves you. Before touching any investment, you need an emergency fund. That means 3 to 6 months of your living expenses saved in a regular savings account. Not invested, just sitting there. Why? Because investing money you might need within 6 months is a trap. If the market drops right when your car breaks down, or you lose your job, you'll be forced to sell your investments at a loss just to survive. That is the worst thing you can do. So look at your monthly expenses. If you need $1,500 a month to live, your emergency fund should be between $4,500 and $9,000. Once that is in place, and only once it is in place, you move to step 2. Step 2. Eliminate high-interest debt first. This sounds counterintuitive. People want to skip this step because investing feels exciting and paying debt feels boring. But let's do the math. If you have credit card debt at 50 or 60% annual interest, which can happen in many countries by the way, your investments would need to earn more than 50% per year just for you to break even. The stock market averages around 10%. So you are losing ground every single day you keep that debt alive while trying to invest at the same time. Pay off anything with an interest rate above 8 or 10% per year before you start investing. A car loan at 12%. That is definitely worth thinking about carefully. A credit card at 60%. Destroy it first. This is not optional if you truly want to build wealth. Step 3. Find out how much you can actually invest. Most people skip this step too, and that's what destroys them. They invest a random amount, whatever feels okay that month, with no real plan. Then something comes up, they stop investing, and everything falls apart. You need a budget, not a complicated spreadsheet, just a simple rule. The most popular one is called the 50-30-20 rule. 50% of your income goes to needs, rent, food, utilities. 30% goes to wants, going out, entertainment, the things you enjoy. 20% goes to savings and investments. If your income is $3,000 a month, that means $600 a month going toward your financial future. Now, $600 a month might sound like a lot, or it might sound like very little. The point is not the number. The point is having a number, a specific amount that you invest every month, no matter what happens. This is called dollar cost averaging. Wait, and it is one of the most powerful concepts in personal finance. You put in the same amount every month, whether the market is going up or down. When the market is down, you automatically buy more units for less money. When the market is up, the units you already own are worth more. Over time, this smooths out volatility and almost always leads to strong returns. Step 4. Choose where to put your money. Now, this is the part everyone wants to jump to, and it's also the part where most people get lost, because there are a million options and everyone has a different opinion. So let me cut through the noise. If you are a beginner, and most people watching this are, you need to start with two things: a tax-advantaged investment account and index funds. In a dollar-based system, that means exploring three main options. The first is a tax-advantaged retirement account, such as an IRA, a Roth IRA, or a 401k, depending on your country and work situation. The idea is simple. The government may give you tax benefits for investing in your future. If you're in a 30% tax bracket, every $100 you contribute to a deductible account can reduce part of your tax burden. That is a real advantage before the market does absolutely anything. It is one of the best long-term wealth-building tools available, and many people do not use it properly. The second option is an investment account through a brokerage firm or an investment platform. In dollars, many people use platforms like Fidelity, Vanguard, Charles Schwab, Interactive Brokers, or simpler apps like Robinhood, depending on where they live. Many of these already let you start with very small amounts, some with as little as $100. You don't have to wait until you have a lot of money to begin, and this is where index funds come in. The third piece of this puzzle. An index fund is basically a basket of many stocks from different companies at the same time. Instead of betting everything on one single company, which is extremely risky, you buy a small piece of hundreds or even thousands of companies at once. If one company goes bankrupt, it doesn't destroy you because you own many others. Index funds that track the US S&P 500, for example, give you exposure to the 500 largest companies in the world: Apple, Microsoft, Amazon, Google, and so on, with one single instrument and very low costs. Why do low costs matter? Because the fees charged by some active funds can eat up between 1 and 3% of your money every year. That might sound small, but over 20 or 30 years, that difference can literally represent hundreds of thousands of dollars going into someone else's pocket instead of yours. Always look for funds with low fees. In English, these are often called low-cost funds or ETFs. Step 5. Understand risk and don't panic. This is the step where people take real money and throw it in the trash. The stock market does not move up in a straight line. It goes up, down, up, down. There are years when it drops 20 or 30%, and when that happens, the instinctive reaction is to sell everything so you don't lose more. If you listen to that instinct, it will cost you a fortune. Look at what happened in March 2020 when the pandemic hit. Global markets dropped almost 35% in a matter of weeks. It was brutal. People panicked and sold. And then, over the next 12 months, the market didn't just recover, it went up more than 70%. The people who sold during the panic missed that entire recovery. The people who stayed still, or even better, kept investing every month, came out way ahead. Warren Buffett, the most successful investor in history, has a quote that says something like this: "The stock market is a mechanism for transferring money from the impatient to the patient," and he is absolutely right. Investing is not exciting. It's not like the Wall Street movies. It's boring. You put money in, let it grow, don't touch it, and 10 or 20 years later, you look back and can't believe what you have. Step 6. Diversify as you grow. Once you already have the basics working, your emergency fund complete, bad debt eliminated, and monthly contributions going into index funds, then you can start exploring more options to diversify. What does diversifying mean? It means not putting all your eggs in one basket. It means having different types of investments that react differently to economic conditions. For example, in addition to stock index funds, you can add government debt instruments like treasury bills, government bonds, or bond funds. These are backed by governments, tend to be more stable than stocks, and can give you a fixed or more predictable return. They won't make you a millionaire overnight, but they can be a stable part of a balanced portfolio. In many cases, you can start with small amounts, sometimes with as little as $100. You can also consider real estate through what are called REITs, real estate investment trusts. They are like investing in properties without having to buy an entire apartment. You buy a small piece and receive dividends from the rent payments. It is a way to get exposure to the real estate sector without needing millions of dollars. The key to diversification is this: you don't need to get into everything at the same time. Start simple. Index fund plus bonds or government debt instruments. And as you learn more and have more capital, you can gradually expand. The problem that destroys most people: comparison and greed. Here's the real challenge no one tells you about. It's not the market. It's not the funds. It's not the instruments. The real enemy is your own mind. When you start investing, you're going to see people on social media bragging that they made 300% on some random cryptocurrency. You'll see ads from platforms promising guaranteed returns of 20% per month. You'll hear a friend say he put everything into one stock and doubled his money in 3 months. And you'll feel that pull. That voice saying, why wait 20 years if I can do it in 3 months? And that is where people lose everything. Cryptocurrencies are extremely volatile. For every person who made 300%, there are 10 who lost 90% of their money. Guaranteed returns of 20% per month are scams, almost without exception. That is more than 240% per year, and no legitimate instrument gives you that consistently. And the person who doubled his money on one stock in 3 months probably lost it again in the next 3 months. But of course, he doesn't post that part online. Successful investing is the art of being consistently boring. Money is built slowly, with consistency, with patience. The fast path almost always ends in loss. The key moment that changes everything. There is a concept that once you truly understand it, completely changes the way you see money. It's called compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Although he probably didn't say it exactly like that, the point is that the concept is so powerful it should be taught in every school from elementary level onward. Compound interest works like this. When your investments generate returns, those returns are added to your original capital, and the next month, those returns also generate returns. And this continues month after month, year after year. Your money begins to grow on top of itself. At first, it doesn't feel like much. The first 2 or 3 years are slow. You see your money growing and think, this is what I waited for? But after year 5, things start to accelerate. After year 10, the growth becomes noticeable. After year 20, it is almost hard to understand. If you invest $200 a month from age 25 to age 65, with an average annual return of 10%, you end up with approximately $1.2 million. $2,000 a month, 40 years, $1.2 million. The total you put in from your own pocket was less than $100,000. Most of the final amount were generated by money working on its own, multiplying on top of itself year after year. That is compound interest in action. But, and this is the most important point of all, if you wait until age 35 to start, those same $200 a month with the same return give you approximately about $450,000, not 13, $450,000. A difference of more than $800,000 just because you waited 10 years. Every year you wait costs you more than you imagine. The best time to start investing was 10 years ago. The second best time is today. So to summarize the complete path and steps, you can begin today. First, build your emergency fund with 3 to 6 months of expenses. Second, eliminate high-interest debt, especially credit cards. Third, define how much you will invest every month and make it automatic. Fourth, open an account on an accessible platform like Fidelity, Vanguard, Charles Schwab, Interactive Brokers, or an equivalent option in your country, and start with index funds and bonds or government debt instruments. Fifth, don't move when the market drops. Stay still, keep investing, and trust the process. Sixth, diversify little by little as you learn and grow. You don't need to be an expert. You don't need to have a lot of money. You don't need to wait for the perfect moment. The only thing you need is to start with what you have, where you are today. The difference between people who build wealth and people who don't is rarely intelligence or luck. Almost always, it is simply that one person started and the other kept waiting. Don't keep waiting. If you want to go deeper into exactly how to choose the best investment funds for your specific situation, the next video explains everything. Don't miss it.